Most people hear these three words early in their investing journey: stocks, bonds, real estate, and immediately they assume one of them must be the best. They look for a winner, the ultimate answer, the one asset that will solve everything. But the truth is simpler and far more useful. There is no best asset. There is only the right role for each one. This comparison matters because every investor eventually asks the same question: where should I put my money? And the mistake most people make is treating stocks, bonds, and real estate like competing ideas, like they're fighting for first place. They're not. They're different tools. And tools only make sense when you understand what problem they solve. A hammer is not better than a screwdriver. It depends on what you're trying to build. So instead of arguing which one is superior, the smarter approach is to understand what each one represents, what it's designed to do, how it behaves under stress, and what trade-offs it comes with. Because every asset is a trade-off. There is no perfect choice, only a choice that fits your goals, timeline, and temperament. Let's start with stocks. Stocks are ownership. When you buy a stock, you own a piece of a business. That business sells products, earns profits, hires employees, creates value, and ideally grows over time. Stocks are designed for growth. Over long periods, they benefit from innovation, productivity, new technologies, rising earnings, and long-term economic expansion. When society becomes more efficient and businesses become more profitable, stock owners benefit. That's the core idea. You're buying a share of human progress through the lens of companies. But stocks feel volatile because they move every day. Prices rise, prices fall, sometimes for no obvious reason. And that volatility scares people because the price is always visible, like a scoreboard that updates every second. But volatility is not automatically danger. Volatility is often the cost of growth. Stocks reward patience, not comfort. If you want the long-term upside, you have to tolerate the short-term swings. You're paying for future growth with present uncertainty. Now bonds. Bonds are not ownership, they are loans. When you buy a bond, you are lending money to a government, a municipality, or a company. In return, you receive predictable payments, typically interest, and then you get your principal back at maturity, assuming everything goes as planned. Bonds usually have lower volatility than stocks, and because of that, they tend to offer lower long-term returns. Bonds are designed for stability, not excitement. So why do bonds exist at all? Because stability has value. Many people think bonds are boring. They are. That's the point. Bonds reduce portfolio swings, they provide predictable income, they create structure, they act like shock absorbers. They don't make you rich fast, they help you stay invested. And that's not a small thing. Most investing success is not about finding the highest return on paper. It's about building a strategy you can stick with when the world gets chaotic. Bonds become especially important when your time horizon gets shorter. If you need money soon, for a home purchase, for education, for retirement, large drops become dangerous because you might be forced to sell at the wrong time. Bonds help reduce that risk by smoothing the ride. Now, real estate. Real estate is physical ownership. You own land, buildings, and space. Real estate can generate returns in multiple ways: rental income, appreciation over time, and leverage, meaning you can use borrowed money to control a large asset. Real estate sits somewhere between stocks and bonds. It can provide income like bonds, and it can provide growth like stocks, but it also comes with unique risks and responsibilities. Real estate feels safer to many people because it's tangible. You can touch it, you can see it, you can walk through it. That tangibility creates comfort, but comfort doesn't eliminate risk. It often hides risk better. Real estate can fall in value. Tenants can leave. Repairs can be expensive. Interest rates can rise. Taxes can change, regulations can tighten, local markets can decline, and unlike stocks, real estate is illiquid. You can't sell a bathroom or a kitchen, you sell the whole thing, and that process can take time and money. Real estate is also not passive by default. It requires management, maintenance, and decision-making. Even if you hire someone to manage it, you are still responsible for the asset. There are liquidity trade-offs and hidden costs: repairs, insurance, vacancy periods, legal issues, transaction fees, and time. Returns can be strong, but the effort and risk are real. So here's the simplest framework. Stocks are mostly about growth. Bonds are mostly about stability. Real estate is a blend, often income plus growth, sometimes amplified by leverage. Each one plays a different role. And the best investors aren't the ones who pick the best asset. They're the ones who assign the right role to each asset inside a portfolio. That's why professionals don't go all in on one asset. They build portfolios. They combine assets to balance risk and return. Because diversification is not about owning everything, it's about owning things that behave differently. The goal is not to collect assets like trophies. The goal is to build a system that survives different environments. And these assets really do react differently. In strong economic growth, stocks often lead because businesses expand and profits rise. In uncertainty or recession fears, high-quality bonds often stabilize portfolios because investors seek safety and predictable cash flows. In inflationary periods, certain types of real estate can help because rents and property values may rise over time, although inflation can also raise costs and interest rates, which affects real estate too. The point is that different assets respond differently to the same environment, which is why mixing them can reduce the chance that one scenario destroys your plan. But your time horizon matters more than the asset itself. If you have decades, volatility matters less and growth matters more. Stocks often play a bigger role. If your horizon is shorter, stability matters more. Bonds become more relevant. If you need income, bonds and real estate can play a role, but the choice depends on how much effort, risk, and illiquidity you can handle. And risk is not just volatility. People think risk means price movement. It doesn't. Risk is being forced to sell at the wrong time. Risk is needing cash when assets are down. Risk is overconcentration, having too much in one stock, one sector, one property, one city, one strategy. Each asset carries different risks. Stocks carry market risk and emotional risk, the risk that you panic. Sell. Bonds carry interest rate risk and inflation risk, the risk that your safe returns don't keep up with rising costs. Real estate carries liquidity risk, concentration risk, and operational risk. The risk that your asset requires time, money, and problem solving. This is also why younger investors often lean towards stocks. Time is on their side. They can absorb volatility, they can wait, they can recover from downturns. Growth matters more than stability early on because the biggest advantage they have is time. But as goals get closer, protection matters more. Bonds reduce the chance of large drawdowns at bad moments. They smooth the ride when the timeline shrinks. So where does real estate fit best? Real estate shines when cash flow matters, when leverage is used responsibly, and when time and effort are available. It's powerful, but it's not effortless, and it's not automatically safer. It's just different. Now here's the most common mistake people make with this comparison. People don't choose assets, they choose emotions, comfort, familiarity, fear. Some people avoid stocks because they feel scary, so they miss long-term growth. Some people chase stocks when they're euphoric, so they buy at bad prices. Some people obsess over real estate because it feels tangible and they overload into one local market. Some people cling to cash and bonds because they hate volatility and they slowly lose purchasing power over time. None of these choices are purely mathematical. They're emotional. That's why balance beats optimization. Trying to pick the best asset often leads to chasing performance, buying what recently went up, avoiding what recently went down. Balance leads to durability. Durable portfolios survive different environments. They reduce the need for perfect timing. They reduce the chance that one wrong bet ruins everything. So here's the simple framework that actually works. Instead of asking, which asset is best? Ask, what role does this asset play? Growth, stability, income. That question clarifies everything. It turns investing from a guessing game into a design problem. And here's the deeper truth. Wealth isn't built by perfect picks. It's built by staying invested, managing risk, and avoiding emotional mistakes. Assets are tools. Behavior decides outcomes. You can have the best asset in the world and still fail if your behavior is unstable. And you can have a simple, diversified plan and succeed because you stayed consistent long enough for compounding to work. Final thought, stocks, bonds, and real estate are not rivals, they're teammates. When used correctly, they support each other. The smartest investors don't argue endlessly about which one is best. They build systems where each asset does its job, so the investor can do theirs, stay consistent, stay disciplined, and let time do the heavy lifting.